excited. Welcome. Our live is almost ready. We're almost live streaming. I have 3 streams going on. This is so amazing. Thank you for my Zoom, my school community, Facebook and Instagram. Thank you, everyone. We're about to definitely talk to high income earners and entrepreneurs. This is the call for high income earners and entrepreneurs, right? Um, this is about to be an amazing call to break down important business structure, right? And tax compliance. So easy. It's gonna be so easy. Y'all are gonna love this. I've been teaching this for 2 weeks now. Um, I taught it last week on a webinar, and I just taught it again on Sunday in Atlanta to a group of women. Um, Everyone is finding this information to be absolutely vital and useful. So, super excited. Let's check on this live stream. Perfect. We are good to go. All right. Well, thank y'all so much for attending. Finally got to, get back to my I'm a ball in Houston, so I'm excited to be back in Houston tonight. This is where I'm presenting to you all from. So, all right, get to be back on Central Time. All right, so great day. I want to be clear. All right, when I talk about when I speak on high income earners, right? When I'm talking about high income, I don't want you to automatically think that you are winning, okay? Because usually high income earners are overpaying, right, in taxes. And that's because, you know, we don't have any structure, right? But I was there, and so that's why I can talk about this, right? I can talk about this because I was there, right? So, again, my name is Maishi Epstein. If you do not know who I am, Maishi Epstein is the correct pronunciation. Well, Maishi Epstein Rutledge now. I am still newlywed. So know that I just don't file taxes. I actually position high income earners to build structured, right? To actually build structured, compliant, and strategically aligned businesses, okay? So I do want to establish that authority and let you know where I'm coming from, right? I am a master level financial therapist, right? I have these credentials. So, and I want you to understand that as a high income earner, okay, and business owner, that taxes follow a formula, right? I'm not talking about a magic formula that you put in, right? I'm talking about knowing that your income matters, right? After the adjustments. And what are the adjustments? Are going to be deductions, credits, right, that you could possibly qualify for, right, that reduce what we call your taxable income, okay? This is the money that you're actually going to have to pay and have a tax liability on, right? Or either a refund from, okay? So this is the formula. And once you know that, you can start strategically planning, right? And start understanding the financial implications of your, or the tax implications of your financial decisions, right? And if you do not understand this, you cannot control your outcome, right? And that's gonna mean you don't have a strong foundation to build on, right? And that's what happens when we start building as entrepreneurs. We make this money, right? Then we don't have any structure to it, and then we end up losing it. Then we build it back up again, and we thinking we did something. We know we did something wrong. We can't pinpoint it, but it's the structure, the foundation there, right? We're not understanding um, the tax implications of our financial decisions as business owners. Okay, so some of us don't even understand how our filing status plays, right? Um, into and determines your tax brackets, okay? So whether you're filing single, married filing jointly, let me see, head of household, married filing separately, right? Qualifying surviving spouse, like all of these are filing statuses, right? And you need to know, right? Based on my situation, how I live, right? How I provide for myself, right? Who else I may care for, okay? Who lives with me, right? All of that matters when you're talking about your filing status, okay? And if you don't understand that, you could possibly be missing out on tens of thousands of deductions that can help your bottom line, right? So, what I'm saying is, you can have the same income as somebody, but this does not mean you're going to have the same tax results, right, as them. It all matters of the tax strategy, okay, not the tax income. All right. So understand that you are also not just taxed on one, tax rate. The United States, we have income, and it flows through brackets. All right. There are actual 7 tax brackets. Okay, ranging from 10% to 37%. Right. As United States citizens, we are actually taxed in layers, right? And it's so important to know like what layers are you falling in, right? So you need to know that not just what you make, right? But what are you being taxed on, okay? What am I being taxed on? That's a big difference, okay? You can still be a high income earner, right? With low tax liability, all right? Or either in no tax liability. It just depends on your tax strategy and structure. All right. But I want you to know that even before we start this strategy, right, based on your filing status, okay, the IRS does give you what we call a standard deduction, right? This is a deduction that the IRS configures and gives to you based on your filing status, right? So let's just say you've been filing single, which has a deduction of 14,600, but you actually have a child that lives and depends on you, right? That's 21, right? And you haven't been claiming head of household because you didn't know. You thought after 18, you didn't know, you wasn't aware, right? And the head of household filing status is 21,900, right? That's a big gap when it comes to deductions and tax liability, all right? So you need to know not only, a strategy, but before you even get to the strategy, you need to have a baseline. What is your baseline, right? So you need to understand that, all right? That's just the simple, right? Before you even start doing the strategy. Now, I'm going to give you some more insight, right? So, I want you to know that you are not taxed on what you make, you are taxed on what remains after tax strategy, okay? That is what's important, okay? So, I want you to have that mindset shift, okay? Yes, I make this amount of money, but because I got this type of tax strategy, right? I'm able to grow, right? My earnings instead of having to pay them back at the end of the year, right? Because I made smart tax decisions. I knew the financial, the tax implications of my financial decisions, right? I made wise decisions. So, what we talk about, what you're being taxed on, we call that something. It's your adjusted gross income, right? And that controls your eligibility for so much, right? That's when we get to having people that may used to be, having 3 kids and in school, in nursing school, and they was making $20,000, $30,000, and they was used to getting a refund, and now they graduated, they got this amazing job, and now they're making $80,000, and they're wondering why, they're owing in taxes now and not receiving a refund, right? That's a big difference because people don't understand how the adjusted gross income controls your eligibility to, common credits, okay? And also help you, you may qualify for fewer deductions, okay? So actually, it introduced limitation when you start earning more money, right? Um, the IRS has things called phase outs, right? So all these common credits that you hear about, like the child tax credit, the education credit, the earned income credit, they all have phase outs, right? So, for an example, when you start earning over 60K, no matter how many kids you have, right, their earned income credit is wiped out, right? You're not eligible for it because your AGI is too much, right? And even if you were in school and you was going after the education credit, after earning over 90K, right, you don't qualify anymore. And you don't know if you don't know, right? The child tax credit, everybody, looks forward to that every year. But even that has a phase out, right? 200 K if you're single household, 400K if you're married filing jointly, right? So credits have phase outs based on your AGI. And when you are aware of that, right, you can have better tax strategy planning throughout the year, okay? So all in all, higher income removes common benefits, right? It does. And seeing that, you see the type of income you'll have to make to even qualify for some of that, right? Not even all of that, okay? So if income isn't the real strategy, what is, right? Structure. That's why structure is important. Because based on structure, right, you are taxed differently, okay? Not just how much, right? But how is taxed, right? So the structure matters, whether or not you're a sole proprietor, a LLC, a S corp, or a corporation. Each of these entities, right, are taxed differently. Okay, so for an example, many people, think that hey, the LLC is the end all be all, right? But what happens when you're a single member LLC, right, and you are now earning 250K and you are in the 35 percent tax bracket, right, as a single person, and you got to pay 35% on top of that self-employment rate of 15.3%, and now you're owe your income back in taxes. So what are you really making? Because you got to understand, no matter how much your tax bill is, you still have to pay your business expenses. You still got to pay yourself. You still got your personal bills, right? You get, so you still got your, utilities. You still got operational costs. Like, you still got so much. So what are you really taking home? So now do you understand the importance of having a good tax strategy, right? So now you can make sure that the money that you are making and earning is used wisely, right? So that it can grow in your business. You can make sure that, hey, before I spend $15,000 on something that is not useful, helpful, right, or necessary for my business or ordinary, right, I'm going to go put this $15,000 in some type of IRA or self plan or pension. And I'm going to put it in something that is going to grow me for the future me, right? Before I put it in something that's not tax deductible, right? Before I put it in something that is not beneficial, right? So unless you want to take $15,000 of your W-2 income from your business and spend it on something like that, then hey, that's fine. That's tax money, all good. Oh, I'm getting a call, but I am live teaching. Hello. But yeah, those are some options, just to run and scenarios run in your head, okay? And I want you to also understand the difference between a credit and a deduction. Oh, thank you for the stars. I love stars. Hey, give me some stars. Hey, hey. Okay, so I want you to understand, yeah, the difference between a credit and a deduction because they are two different things, right? I have so many times every year entrepreneurs, hey, Miss, I know I got a lot of credits. I know I got a lot of credits. I'm thinking in my head, no, do you mean deductions, right? And it's a big difference, okay? A credit reduces your tax liability dollar for dollar, okay? A deduction reduces your taxable income. And you may be saying, Macy, what do you mean, right? Just stay with me. If you got pen and paper, write it down. It'll make more sense, right? But I'm going to use whole numbers. $100,000, right? Okay. So $100,000, let's just say the tax rate is 25% so that we can have whole numbers, okay? Um, and so now you are taxed, let's just say, how much is that? 2,500. No, 25,000. Yeah, 25,000. Okay, so $25,000 tax bill, right? So we got a $25,000 tax bill off of $100,000, right? So now this person has a $10,000 deduction, right? So now that tax bill instead of being 100,000, it's going to be 90,000, right? So it's going to be 25% of 90,000. So what is that, like 20 some $1,000, but still not $25,000 tax bill? That's the person with the deduction. Now the $100,000 person with a $10,000 credit, they tax bill come out to be 25,000, but they got a credit for 10,000 that's going to reduce that tax bill dollar. Their tax is 15,000, right? So that way more credit is better than a deduction for one, but I want everyone to understand the difference, okay, and how they play, right, to you. So, and usually, only time people really qualify for deductions as business owners and then they're making profits is when they start being like corporations, when they have like, the work opportunity, tax credits, when they are an accredited investor now and stuff, and they can do different alternative, investments and get credits, or they can buy credits, right? Depending on who you know, right? And what circle you're around. So, but that's another conversation for another day, okay? Just wanted to make sure that y'all understood the difference between a credit and deduction as a business owner, right? And y'all have that common knowledge, right? So, I think I already basically did a case study with y'all and showed y'all the difference, right? In the credit and deduction. I guess I can do something with y'all to show y'all like the difference if somebody had a tax strategy. Okay, so let's think about this. You're a $250,000 earner. Okay, with no structure, you're looking at around $70,000 in taxes. Okay, with structure, let's say that you have an S corp. Okay, and as a CEO, you pay yourself $150,000 salary, so that leaves $100,000 to be taxed on with your K1, right? But you're not getting taxed on that because you have adjustments. What do you have, right? Well, you have a retirement account that you can, you know, deduct healthcare insurance, right? Rent for your business, any supplies, right? Any contract labor. Okay, so now that reduces your income even more. And the great thing about this K1, you're gonna bypass the self-employment tax, right? So now let's just say after you did all of that, right? You're only gonna be taxed on, let's just say, $5,000, right? So basically, you didn't have a tax bill, okay? And if you pay too much federal tax back into your W 2, and if you did it, you should have, right? You'll actually be getting a refund as a business owner, right? So you go from having a 70K tax bill to getting a refund back and keeping all your money. But that is just good tax strategy, right? Um, and guess what? Proof, right? So, but if you don't know, then you don't know, right? And that is exactly why I offer a clarity call to business owners, to entrepreneurs, right? To high income earners, right? This call is for you because on this call is where I show you exactly where you have been overpaying and exactly what to fix, okay? Just to remind y'all, you don't need more. My thing is talking too much. I tell you, but you don't need more income, y'all. What we need to know is how to structure our business and have the proper tax structure as well, right? As high income earners, so that we can have a winning strategy, so that we can keep our money, so that we can stop working so hard, for the same money, season after season, year after year, right? Day after day. When we know that we can actually now enjoy and keep our money because we have smart tax strategy and structure, we can win. I hope I gave you clarity. I hope I gave you exactly what you need. Once we book the clarity call, then I know exactly where I need to place you inside of the ecosystem of development that we offer, y'all. This is a full service professional and personal development firm. We've been doing this for years. We have successfully helped, oh my gosh, hundreds of people probably thousand. Yeah, I'm pretty sure become six-figure earners. Like, this is what we do. We love helping people. We love making sure that you are set up for success as we learn, we teach, and grow. So I look forward to speaking with you all. I look forward to y'all booking out clarity call. And I'll be here. Peace, love, joy, and happiness. Thank y'all. Oh, I am Mashi.com. I am Mashi.com. I am MASHI.com. Okay. You can book the clarity